Do you guys ever wonder how the wealthiest people in America made their fortunes? So, the reason I'm asking you this is because I actually went to dinner this weekend with my friends that I met at the Limitless conference, Jack and Afaf, and they're amazing. They're YouTubers. So, of course, we started talking about different streams of income and the way to build true wealth instead of a get rich quick scheme. Obviously, they have their investments, they make their revenue through YouTube, and then they've had friends that have made wealth either through real estate and the stock market. And so, of course, after dinner, I looked into some stats and I had to share this with you guys. Last year, 35 US billionaires made their money in real estate, according to the Forbes 400 list. And that just made me want to buy even more real estate immediately. And I hope this stat also sparked that desire in you to get on the real estate investment train. Because if that doesn't, I don't know what will. Now that I have your undivided attention, are you feeling motivated to take action? Would you want to be a billionaire like these people in the stats? Because I know all the listeners that tune in religiously do, because you want to change your financial future. So it all starts with finding the best real estate investment deals. And while there's no guaranteed methodology to make this happen, I'm going to share with you the Rich Dad Blueprint for finding the right investment. Today, we're going to talk about the rules and language that help change my family's financial future and help shape my financial life, and what helped us on this journey of financial freedom. I'm your host, Alexandra Gonzalez-Ganoza, and this is where your financial freedom begins. To get started today, let's talk about vocabulary. The foundation for any education is understanding the words. In real estate, there are three key words you need to know. And I think these are the most important three words. And while you're looking out for some deals, use them as a financial compass to guide you towards a good deal. Number one, net operating income, which is also referred to as NOI. Net operating income is simply income minus your expenses. This is pretty much used to determine the profitability of the property. For your expenses, make sure to include insurance, property taxes, repair, and maintenance costs, etc. These are sometimes minimal costs that we sometimes forget to calculate, to keep in this calculation. And when it comes to maximizing your property's NOI, nothing is more important than controlling the actual total income your property produces. As simple as this formula may seem, this helps identify a good investment between a bad one. And most real estate investors, the pros, will typically make financial decisions with a short glance at this calculation. That's how important this is. Number two, capitalization rate or cap rate. You'll hear all the gurus always talk about this. This is another tool that will help you evaluate properties and find a good deal. This is basically the rate of return of a real estate property. Cap rate takes two things into consideration: the potential cash flow and the level of risk linked to a property. Cap rate is net operating income divided by the purchase price. 2 seconds ago, we just learned how to calculate NOI, right? So let's throw in an example here. Let's say your NOI is $12,000, right? And the purchase price of the property was $245,000. Your cap rate, take a calculator, your cap rate is 4.9%. Think of cap rate as your crystal ball to determine how long it might take you to earn back the initial property investment. It's kind of like a sneak peek into the future. So, of course, generally for beginners, the lower the cap rate, the better it is because it means it's less risky. Number three, return on investment or ROI. This you've probably heard on all the house flipping shows like HGTV. ROI is the amount of income you receive from an investment divided by the total amount invested in the investment. It's the amount of cash the money you invested is paying you or returning to you. Another way to put it is, how hard is the money you invest actually working for you? There's several ways to calculate the return on investment depending on what you're measuring. But when we talk about return on investment, we typically mean what's called a cash on cash return on investment. There's one thing here that takes priority, and that's how much cash is flowing into your pocket. And I know we all want more of that. Some formulas take depreciation into account when calculating ROI. Another formula assumes that the cash flow you're receiving is being reinvested immediately, and it takes that into account. And each formula is accurate in its own way, depending on what you want to measure. But for today's lesson, let's keep it simple. It's all about the cash flow. Let's paint a picture because I'm a bit more of a visual learner. Let's say I find this nice, beautiful rental property in Arizona with the perfect location, right? Right in Scottsdale. The property costs, let's say, $100,000, which would be a dream in Scottsdale right now. But I'm going to do the down payment of 20%, right? That's $20,000 in cash. Each month, I have a positive cash flow of $200, which is an annual cash flow of $2,400. That's $2,400, my annual cash flow divided by $20,000, the amount of cash I invested in the property, gives me a 12% cash on cash ROI. Again, the formula is pretty simple. How much cash am I investing and how much cash am I receiving from that investment? The higher your return, the quicker you can use those funds to reinvest in another property and build your wealth. The whole reasoning behind focusing on cash flow is that you want your money working harder for you so that you don't have to work hard for your money. The cash on cash return on investment measures specifically how hard your money is working for you and lets you compare the performance of your investments, basically apples to apples. The beauty of making money on the right side of the cash flow quadrant as an investor in the I quadrant is that that's not where only cash flow happens, but also where the velocity of money takes place. Velocity of money means growing your money by using the cash flow from an investment or from an asset to acquire more assets that produce more cash flow. Does it make sense now how these billionaires built their wealth? Have you guys ever heard of extremely successful people? And when they talk about how reaching their first $100,000 in revenue was a lot harder than getting to their first million, and then getting to 10 million was a piece of cake, even easier than the first million. It's because they used, it's because they used the velocity of money. But simply put, there's a formula investors utilize to create the velocity of money. Number one, they invest in an asset, which is what you're going to be working on. And number two, they get their money back. Three, they keep control of the asset. Four, they move their money into another asset, so they reinvest it. And five, they rinse and repeat. As the rich increase the velocity of their money, the cash flow from their assets far outpaces their expenses, and their purchasing power for more asset grows. They're financially free. So, as I mentioned before, a lot of people just want to get rich quick. But I'm going to give you 3 reasons to focus on cash flow investments and not capital gains focused investments. Because there's a lot of talk about capital gain investing. So, one of them is timing. One problem with investing for capital gains is that you have to get rid of the property at the right time to get your gains. You only have one chance to make a good return on your investment. Another thing would be predictability. With long term capital gain investments in real estate, you have little ways to predict what the market will look like 10 to 15 years from now. Forecasting that far out is virtually impossible. And then there's losses. Every investor suffers from loss at times, no matter what. It's inevitable. The idea of failing fast is a good rule in real estate investments. If your current property is going to be the bad egg in your basket, it's better to find out sooner rather than later. If you hold a property for capital gains and find out 10 years later it was a bad investment, you've not only lost time, but you've also lost your money. And there's also more ways to gain. A cash flow real estate investment has 4 methods of prospering, whereas a long term capital gains focused investment has only one: when you sell. So now that we've got that covered, let's work on skyrocketing your returns in real estate investing. So follow these 5 rules we have for you. Rule number 1 is Realize that cash flow is key. It's number one. If you are investing in real estate, you need to forget about equity. Focus on cash flow because over time, cash flow generates the real profit. Rental properties will generate more cash flow with consistent income. And here's why. If you're trying to build equity over time, it'll likely cause you to lose money. During this time, you're still paying taxes, insurance, maintaining the property, and paying on the debt, the interest of the investment. The profit from your long term or capital gains investment only comes once, but cash flow investments puts cash in your pocket monthly. Equity returns only manifest after years of holding on to a property, but cash flow begins immediately, sometimes with little to no waiting. I mean, I was able to rent my property shortly after buying it, and it started to cash flow immediately. So it can happen right away, depending on the scenario, however you pronounce it. Equity profits are obviously nice, and who doesn't like a chunk of cash given to them, obviously, but it is the cash flow that will pay off more in the long run. Rule number two, know the four real estate profit centers. When investing in cash flow real estate as a business, not your personal home, you create four ways to profit. These profit centers generate profits that outpace most other investment types, even booming stock markets. First, cash flow investing means you'll have tenants, and those tenants pay monthly to rent the property. For example, if you charge $1,000 a month for rent, and that's $12,000 a year in cash flow, you then subtract your taxes, insurance, maintenance, and debt service to see what profit you're making. Second, while you're paying down your debt, the mortgage on the investment property, that principal and interest is being paid by your tenant. They're the ones paying down your debt on a property that you own. Getting technical here, that's what they call amortization. Next, depreciation. Depreciation is the third profit center. Depreciation is often called a phantom return because it's like a ghost. There's no physical cash payment involved, but because the government usually lets property owners take a tax break or deduct or sorry, they usually let you deduct the depreciation of an investment. This results in a savings on your income. This can produce another 5 to 10% of annual return. For the three centers of profit, so far we've accumulated around 30% or more in annual return. The fourth center of profit is appreciation, the opposite of depreciation. It's the increase in the value of your investment property. This is the icing on the cake. So during this time, you've been accumulating cash flow and returns on your rent, right? You're having someone pay down your debt, amazing, and you're taking tax breaks on depreciation. Now you're also building equity in the property that will likely be worth way more than what you've paid for it. This can push your annual return to 50% or more. Rule number three is select the right property in the right market. The best advice is to do your homework and choose a rental property located in a market with long term potential and high occupancy rates. Just look at the history of the market and evaluate the future. Don't choose a property in a volatile area. If you choose a property where markets fall sharply over the years, you'll have a lower chance of cash flow potential. Remember, you're investing in the market, not the property. Once you've chosen a property, you want to evaluate all the relevant location factors such as transportation, crime, safety, schools, established retail, restaurants, and more. This is all stuff your realtor can help you if you're working with one. She can get you all this information as well, or sometimes even provide it on Zillow. But get a feel for the area, drive around, walk around, go to the coffee shop, whatever you need to do to get familiar with it. And ask yourself, if you were a potential tenant or buyer, how would you feel about the area? This helps you determine the value of a property long term. Honestly, that's what I did when I went to go buy my property. It was near an area I had already lived. I loved it. And I went to get a good a feel for like the local nearby Starbucks. I pictured myself, would I want to live there? Because I wanted to attract a tenant with a similar profile as mine. But you need to feel the area and see what kind of tenants you want to attract. And is this somewhere they would want to live? And it's not always about the purchase price of a property. Sometimes a newer, more expensive property can be far more lucrative for cash flow if it's in a steady, desirable, high yield area as opposed to an older, less expensive property in an area that has a lot of turnover with tenants. A lot of turnover with tenants and the potential to have a big market dip in the future. Rule number 4 is manage your properties well. Some of the biggest hidden expenses in a rental property are those related to repairs, turnovers, and vacancies. If you rent a property out and the rental payments start coming in, it's important not to lose focus on things that help keep your property rented and your tenants happy. Make sure you still keep the property attractive and appealing for future tenants or for your current tenant. Positive tenant relations, upkeep, response to maintenance issues are big factors that keep those checks coming in. You want to be a good landlord and not a slumlord. If you're a good landlord, you'll attract the right tenants and you'll keep them also. There'll be a higher retention for them. I'm never going to forget when I was renting in an area I absolutely loved, but the landlord was an absolute slumlord. He never wanted to fix anything, he never wanted to do any repairs, and he took forever to respond. I mean, it was terrible, but I loved the place, I loved the unit. His turnover was high, and the cost to find a new realtor to make up for the vacancies, all that affects his cash flow, and it did. It affected his cash flow. So that's a lesson to learn from him. And it's also fine because that's actually what pushed me and motivated me to go and buy something to own myself. It's hard work and expensive to keep up a property, but by staying focused on making sure your property is still desirable and safe and that your tenants are happy, it will keep the cash flow coming in. Honestly, keeping my tenants happy makes me happy. You also feel good about creating a home for them and somewhere they love living, somewhere they feel safe. I even did some upgrades. And when you do upgrades, yeah, they're expensive initially. Like, I don't know, adding a security system, adding double bolts to the lock or like those locks with the keypads on it. It helps them feel safe. It helps them feel protected. It makes them happy to live there. And honestly, I just went above and beyond for my tenants. And it's an amazing feeling because it also pays off. The more upgrades you do, the higher rent you can charge, and the better quality tenants you attract. And rule number 5, trade up in value. There's actually a really good example of trading up in the game Monopoly. 4 greenhouses leads to 1 red hotel. This is a simple but effective reminder of how to build wealth. Someone on the live we had last month actually brought this up. They commented on it, and I figured it's perfect for today's episode. So, whoever that was, thanks for mentioning it. Big profits come from larger properties. But first, you have to start somewhere, and that somewhere is somewhere small. Investing in smaller properties for cash flow can give you the stepping stones to trading up and investing in bigger properties. I see this as like a strategic swap or your ticket to success. Imagine this: you trade in those smaller, not so flashy properties for a bundle of cash and then splurge on a bigger and better real estate deal. You guys know I'm a visual learner, so picture this because this makes it also simple. It's simple. It's like upgrading your investment game from 3 bicycles to, I don't know, your dream car, like a Ferrari. I think mine would be like honestly a Porsche. I've never been into like Ferraris or anything like that, but honestly, I don't even know why I gave that example since I'm not a huge fan of cars, but you guys get the point. I figured some viewers here might be interested in that topic. And well, now back to the moral of the story. You get to see your bigger returns do all the work. However, there is one catch. When you cash out or sell an investment property for more than what you paid for it, you receive a capital gain, right? And this is obviously your reward for playing the investment game well. But Uncle Sam wants a piece of your gains, and both the federal government and a handful of states will take a piece of the pie you just earned. And this shouldn't cause you to freak out because this tax is a lower percentage than income tax, but it will cost you to cash out with a profitable investment property. But Here's a totally legal and legit way to keep your earnings. Dodge the capital gains tax, trade up, and build your wealth. You can use an incentive from the IRS called a 1031 exchange. You can take the capital gains from a sold property and use that money to invest in another property. This allows you to roll over that profit and not be subject to the tax. There's strict requirements and you have to fill out forms correctly, but it's a good option to avoid the capital gains tax when trading up. And you keep those gains right where they belong, which is in your pocket and not in Uncle Sam's pocket. The 5 rules I just mentioned can help you skyrocket your returns as a real estate investor. The factors, rules, and tips will help keep you educated, moving forward, and focusing on ways to build your wealth in real estate investing. While simple rental can bring income and cash flow, knowing how to build upon that rental, how to keep your tenants happy, how to utilize tax breaks, and ultimately trade up for a bigger, more profitable investment is the key to your success. Truly picture this and visualize this scenario. You keep your tenants smiling from ear to ear, you maximize those amazing tax breaks, and then you trade up for bigger investments that promise greater returns. This is your reality. So keep on working on getting your 3 greenhouses and then your 1 red hotel. And as I was telling my friends this weekend, I see real estate as a long term investment game, and it's wealth that just builds on itself. I think this is the difference between getting rich quick and building generational wealth. Thank you guys so much for tuning in and unlocking the rules to real estate riches with me. Having you guys as a community honestly really inspires me to think of topics that not only educate you, but also educate me and grow my financial education as well. And it holds me accountable to my growth, to my personal development, and to keep on educating myself in these topics, to keep on looking for more investments and keep fighting for my financial freedom. And I hope this is also a reminder of surrounding yourself with, you know, like-minded people, people that are on the path that you want to be on. Because even having casual conversations with friends, if they have a different perspective, that casual conversation changes. It's not so much about weekend plans, but more about what they're doing to work on their personal development. And so I really encourage you guys to surround yourself with those people, force yourself into those environments, because your environment has to be stronger than your mentality, honestly. And keep on educating yourself with these podcasts, with other podcasts in this space. Subscribe to our YouTube channel, give this podcast a 5-star review, and keep chasing those returns and building your empire.
This podcast is a presentation of Rich Dad Media Network.